In a world of lazy shortcuts and get rich quick trends, the most radical thing you can do is actually follow the fundamentals. Is what I'm about to tell you for everyone? No. You might not agree with me or how I think, but I work with successful families across multiple generations, and this is the framework I use at every stage of their investing life. Simply put, this is how I grow and manage multi-million-dollar families. It comes down to a single distinction. Most people are occasional savers. I teach people how to be educated investors. Traditional retail advice is designed to make you feel safe. But wealthy families are out playing offense while you're feeling safe. They understand that risk is relative. What the average person calls risky, the 1% calls an opportunity. The reason most people stay conservative, or one of the reasons, is that they've been told risk tolerance is a personality trait or a gut feeling, and I think they're wrong. I believe that risk tolerance is a skill, not a feeling. It's a muscle you build through education and experience. When you stay conservative because of a feeling, the math is against you winning, period. My 12-step map is designed to build the skill of risk so that you can actually fix the math in your favor. I built out this Vickerson method. I don't expect you to memorize it or take notes while you're watching this. I put an interactive version of this entire system on my website, along with an AI-driven assessment tool that helps you find exactly what step you're on. It's free, it's not gated behind an email capture. You can just go and use it right now. Step 1 is front-loading your risk. When you're young and flexible, high risk is the engine for high reward. You should prioritize growth early to maximize the power of compounding. But risk isn't just a word, it's a reality that you have to face to be invested in the markets. To illustrate the point of what risk might look like, here's an actual fund document. Now I've redacted the names because I'm not here to sell you a product. I'm here to show you a system. One of the things people go to right away is the management cost, the MER. They see a fee and they stop there. But the top 1% of these don't look at fees in isolation. They also look at the net return. It's the result that actually lands in your pocket after that fee is paid. If cheapest was best, we would all own the cheapest car. And I don't look for cheap funds. I look for efficient ones. If the net outcome is superior, the fee is a secondary conversation. If you focus only on the fee and ignore the net result, you are being fee wise, but you're being wealth foolish. Now I need to show you the volatility here. This is the whole purpose of this fund. It's to get the fair and balanced picture of the strategy. You have to look at the actual calendar year returns. In this row, you see the trade-off. There are years where the fund takes a significant double-digit hit, and other years where it captures massive market-leading surges. This isn't a straight line fund. It's a series of aggressive swings. If I only showed you the growth of this without showing you these down years, I'd be misrepresenting how this wealth was actually built. The trade-off is what you have to be ready for. This is what front-loading the risk is actually like. You can find safer funds with lower fees, but you'd be missing the most important part of the process. That's the education. If you get the same end result as someone else, but they didn't learn how to handle the ride and you did, who's going to be further ahead 10 years from now? You'll be able to handle risk where they won't. So you aren't just building a portfolio, you're building the skill of being wealthy, and that's why you start front-loading the risk. Step 2 is about consistency over timing. Most people call this dollar cost averaging, but I want you to stop using that term. Technically, dollar cost averaging is what you do when you have a lump sum of cash, an inheritance or a bonus, and you're too afraid to put it in the market all at once. So you average it in slowly over months. Statistically, you're wrong 68% of the time you do that. The market moves up more than it moves down. The hesitation is literally costing you money. I want to reframe this as systematic investing. So this is putting every dollar to work the second it hits your hand. In the early stages, that means it's the moment your paycheck clears, the investment is made. This is the line in the sand between the occasional saver and the educated investor. The occasional saver enjoys their month, pays their bills, and then if there's anything left, they'll save it. The educated investor, they invest first, and then they live off the rest. That's it. Why does this matter? Because you're building the habit of aggressive deployment. If you can't handle putting $500 to work the moment you get it, you won't be able to handle putting $500,000 to work when that day comes. You don't want to be a saver, you want to be an investor. You want the money to be at work so that it can start making money. Step 3 is about training your resilience. Most people think they can just feel their way through a market crash, and they're wrong. To win, you have to replace your feelings with history. And I want you to listen how Peter Lynch, he's the man who ran the most successful fund in history, how he explained this back in 1994.
But you should study history, and history is the important thing you learn from. What you learn from history is the market goes down. It goes down a lot. The math is simple. There's been 93 years a century. This is easy to do. The market's had 50 declines of 10% or more. So 50 declines in 93 years. About once every 2 years, the market falls 10%. We call that a correction. That means, that's a euphemism for losing a lot of money rapidly, but we call it a correction. And so 50 declines in 93 years, about once every 2 years, the market falls 10%. Of those 50 declines, 15 have been 25% or more. That's known as a bear market. We've had 15 declines in 93 years. So every 6 years, the market's going to have a 25% decline. That's all you need to know. You need to know the market's going to go down sometime. If you're not ready for that, you shouldn't own stocks. And it's good when it happens.
Peter Lynch understood something that 99% of retail investors miss. Market declines are not rare events. They're regular occurrences. Lynch goes even further, and he says if you like a stock at 14 and it goes to 6, that isn't a tragedy, it's an opportunity. But here's the problem, is you can only see it as an opportunity if you've built the skill to handle that drop.
14 to 22 is terrific, 6 to 22 is exceptional. So you take advantage of these declines. They're going to happen, no one knows when they're going to happen. It would be people tell you about it after the fact that they predicted it, but they predicted it 53 times.
This is why step 3 of this Vickerson method is purely psychological. We're trying to train your emotional resilience. Step 4 is the winter review. In Canada, everyone calls this RSP season. I want you to look at it a bit differently. Think of an orchard. If you didn't tend to it in the off season, it's not going to look like it does in the summer. Your portfolio is no different. You need an annual cadence, a time to tend the garden. Most people wait until the February deadline to contribute to the RSPs. That's a loser's game. By waiting until the last minute, you've missed an entire year of compounding growth. And yeah, by all means, top it up, get your tax break. But an educated investor has that money working in the market months before the deadline. So you're not waiting for certain seasons, you're just out there playing offense. What we do instead during this review is we aren't just looking at the past, we are scenario planning for the future. I'm not interested in making predictions. Predictions are just guesses. I'm interested in readiness. Are you positioned to act if the market drops 20%? Are you ready to harvest if it jumps 30%? When you have a map for all these different situations, you don't need to predict. You just need to be ready to act when those facts change. So you've applied the principles, you front-loaded the risk, and now you're seeing some of the results. But what happens when your balance hits that first major milestone, $50,000? Most people just keep doing what they've always done. That's a bit of a mistake. Step 5 is where we start to spread the load. Up to 50,000, we stayed concentrated for growth. But once we hit that mark, we start a process of skimming off the top. Every time that high-risk engine generates profit that's over that $50,000 line, we harvest those gains and move them down the risk spectrum. We aren't just diversifying, we're trying to build a fortress across 12 distinct asset classes. And we're using your growth engine to fund it. Diversifying is more than just stocks and bonds. I've recently added in liquid alternatives. What I'm really trying to do is just find opportunities that don't move with the regular market. The secret at this stage is avoiding hidden overlap. A lot of retail investors right now own 5 different funds that all have the exact top 10 companies. They think they're safe, but really they're just super exposed. So my personal value add here is a curated list of funds that I've built that touch specific sectors with zero overlap. It's an extra layer of protection that a single mutual fund just can't provide. You've learned how to handle the swings. Now we're going to use proper diversification to make sure those swings never knock you off the path. I'm not chasing benchmarks. I'm trying to be different. You've stuck with it. Your balance is now crossing that $200,000 to $250,000 mark. We've been diversifying as we've added more, but now we have the opportunity to strategically rebalance. This is where we actually sell high and buy low. Yeah, it's a simple concept. Almost nobody is doing it nowadays. Most people have gone out and they've automated rebalancing. happens once every 3 months. I think that's a lazy shortcut. If a sector has a strong headwind, an automated system is going to pull you out of it too early, and you'll constantly miss out on those advanced returns. We don't automate something this important. We take profits prudently. We let the funds move with the market. Because we've done the research on a curated list of funds, we believe in the management. So when a sector is under pressure, we don't panic. That's a clear buy signal for us. We take the money from the things that have done well and put it into the things that haven't performed well yet. It's systematic, it's repeatable. It's not something that should be handled by a machine. It should be used strategically to bring real value to the portfolio. We're halfway through. I know this can feel like a lot of moving parts. As a side note, to achieve everything that we're talking about, I leverage a lot of tech. I keep it in the background. I don't feel like tech should ever be involved in our meetings. It's meant to do all the heavy lifting so that you and I can do the human thinking. Up until now, we've only talked about the investment side. But as your balances grow towards that $500,000 mark, your investments have more and more tax consequences. It is vital at this stage that we start considering how we're using your accounts. How much do we want in RSP? How much do we want in the tax-free savings? Should we keep retained earnings in your corporation? At this point, the question is how can we pay the least amount of tax over an entire lifetime? To answer that, I like to meet with your accountant. They have access to your cash flow. I have access to your investments. I'm a big believer that no one person knows everything. So while I specialize in maximizing your investments, your accountant specializes in minimizing your taxes. When we work together, we can start to build an entire picture for you of tax efficiency and maximized returns. So just like I treat a portfolio where I build a team of professional managers who are each specialists in their specific sectors, I believe in doing that for your life as well. You need a team of specialists to support everything you need as you move into these higher balances. Step 8 is where we add the spring and fall reviews. To think I could manage $1 million plus portfolio with just 1 hour a year, it's a disservice to you. The spring meeting is about your retirement goals. It's an aspirational meeting where we lay out what a perfect retirement looks like for you so we can start planning to hit it. It's one of my favorites because it's all about you. We do touch on the investments, but really the focus is on you and what you want to achieve. Then summer hits. Nobody wants to talk to me, and that's okay. You should be out enjoying your life. That's why you hired me. I spend this time doing a deep dive into your investments, making sure that we still have the best of the best looking after each sector. All that stuff we talked about in the spring, well, that's what I'm working on in the summer, so it's ready for our final meeting of the year, which is our fall harvest. In the fall, we come back together to check in on how the year went. We check to make sure your tax plan and contributions are on track. We see if any rebalancing needs to be done, and then we take a look at your estate plan. Keeping those beneficiaries current and the plan clearly outlined is the only way to ensure the long-term success of your family. By now, you've heard me say it a few times, but it never loses its importance. It's systematic and repeatable. By doing this all on repeat, we stay on top of a complicated financial life. Wealthy families don't just wing it. They follow a set cadence. All right. You've retired. Step 9 is the fruition of all of those spring meetings that we've had over the years. You're past $1 million mark. It's now time to build your paycheck for life. This is a pivotal time to pull in the accountant that we've been working with. We're coordinating every source of income, your CPP, your old age security, your RIF payments, your tax-free savings, and your corporate accounts. And putting all of this into the most tax-efficient sequence possible. It's about turning your investments into a sustainable long-term paycheck. From experience, I've seen that the biggest hurdle at this stage is the psychology. You spent decades being a diligent saver, and now reaching into that pot, it feels like a loss every time the balance drops. We solve that by building a monthly paycheck that mimics the way it felt when you were working. It removes the stress of spending down your life savings. The plan we've built is to sustain your assets, or even keep improving them, while you're actually living. We've set up your income to live your retirement dream. We now have to sustain it, and that takes us to step 10. Step 10 is our cash wedge. You're going to be retired for a long time, 30, maybe 40 years. How are we going to make sure that you have enough? Traditional thoughts say, you're retired now. You can't take any risk. You better put everything into a low-risk investment. Well, that's going to kill things. If you're getting a 5% return, you're just barely beating inflation and taxes. That doesn't feel like safe to me. If you've been walking through the Vickerson method with me, you know we think about capacity. If you're going to be retired for 30 or 40 years, that's a long time horizon. Your capacity is actually more than you think it is. I looked back in time at all of the black swan events, the financial crisis, COVID, the inflation of the 70s, the dot-com crisis. What I noticed in common is that within 2 years of a significant market drops, markets are generally back to all-time highs. So if that's true, my thought is that we protect 2 or 3 years worth of income. It's what you need in the short term. It covers that black swan event. So 2 or 3 years, whatever you're comfortable with. And those lower risk investments that you were told you're supposed to put everything into. But now we have enough income set aside to cover you during those years when things are down. What it does is give your growth engine time to move up and down with the market. Because as you know, good investments come back. This is called a cash wedge. Some advisors use a savings account. I like to use a low-risk bond fund. Every year when we rebalance, we just take the profits from the growth and we put it into the lower-risk holdings. And that's how we continue to fund your retirement paycheck. We've been rebalancing the whole way along. Now we're just rotating it down to pay your paycheck for you. This keeps your money working for you. It's built on the understanding you've learned along the way at each step of this process, and this all sets you up for success here. To pair with the cash wedge that we just set up, step 11 is a stress test of your portfolio. This is where we repeat the system we've already built. We stay on that 3-meeting cadence, winter, spring, and fall, to make sure the plan we've established stays on track. I'm still going to ask those aspirational questions about what you want to do with your time. I'm still going to bring you ideas that I think are interesting for your lifestyle, but by this stage, a lot of the big problems are already solved. So what we're doing now is looking for things that could derail the plan. We are constantly scanning for short-term changes or unexpected events. Anything that could knock the plan off course. We stay ahead of them so that we're ready to react the moment they become facts. Being proactive instead of reactive is how we stay successful at this stage. I know this sounds like a repetition of step 8, and honestly it is. It might even seem a bit boring. But when you're actually living off of your assets, that boring is a luxury. It means the plan is working exactly how it was designed to. I can't overstate the importance of staying disciplined here. We've built the engine, we've secured the wedge, and now we just need to keep the plan perfect. And that leads us to our final step, step 12. Step 12 is the final step in the plan, estate planning and legacy. We've been touching on this for years during our fall harvest meetings. Early on, it was just about beneficiaries, but as your assets grow, this becomes a conversation about how to transition what you have to exactly where you want it to go. I haven't talked a lot of numbers in this video. In BC, probate is about 1.4%, and at most $525 in Alberta. People obsess over that. But if you have a $200,000 RIF that gets cashed out when you pass away, the government treats that as $200,000 of income in a single year. They're going to take half in taxes. The 50% tax hit is the real threat, not the probate fees. We are constantly planning for this every year because we don't want your legacy to be a tax bill for your family. This is part of that lifetime tax conversation that we started in step 7. Just like with your accountant, no one person knows everything. I believe you should have a lawyer or a notary who specializes in wills, and my job is to coordinate with them. If you give me the okay, I'll share the asset and beneficiary data they need to make sure that you have a cohesive plan. I've been through a few estates, and that experience has taught me one thing. Instructions matter. Making sure your wishes are actually followed is the whole point of this step. We've built the wealth, we've secured the income, and now we make sure that your legacy is protected. That's the Vickerson method. And I'll be clear, the reason this works isn't because of some hidden market secret. It works because it's systematic and repeatable. Most of the traditional advice that you've heard is lazy. It's designed to let the advisor sit back, stay comfortable, while you just settle for average. My system doesn't allow for a descent into the middle. To repeat, in a world of lazy shortcuts and get-rich-quick trends, the most radical thing you can do is actually follow the fundamentals. I know it sounds like an irony, but in today's market, boring is the new bold. We aren't guessing here. We're executing a machine that has been proven across generations. Real advice should challenge your fears, not soothe them. It should teach you how to overcome them, because education, knowledge, and the understanding of how to use it will trump your feelings every single day. Feelings don't build legacies, systems do. If you found value in these 12 steps, I've made it easy for you to take the next move. On my website, you'll find the interactive map and the AI-powered audit tool that we've discussed. Most people in my industry would be putting that behind a paywall or force you to give up your email address so they can inundate your inbox with marketing garbage. I'm not doing that. I have a successful practice. I'm not starving for leads. I'm giving this away because I'm tired of seeing people stuck in the middle because they lack the right tools. Use the assessment to solve your first level problems. If you decide you want to move faster or you have a complex portfolio that needs a private eye, there's a link to my calendar right there on the page. And look, while I'm a big believer in the math and the systems, at the end of the day, money is personal. I've made it easy to book a call directly in my calendar. No mandatory questionnaires, no digital roadblocks. I'm a person, you're a person. If you like the way I think and you want to see if we're a fit, let's have a conversation. The technology is there to handle the math. I'm here to handle the relationship.